Hello students, welcome to my class. This is the presentation of the overview of principles of accounting. Most students tend to be very rusty when they get to their upper level financial accounting class. So I usually take it upon myself to take 1 or 1.5 hours to go through principles of accounting in this time frame. So our objective today is to talk about some of the fundamentals of principles of accounting and zero in on accounting cycle. Now that being said, let's start off by talking about the definition of accounting. The question is, what is accounting? Now that we have taken about 2-3 classes of accounting, what do you think accounting is all about? Anybody?
Preparing financial statements.
Preparing financial statements? That is part of it. Go ahead.
Money management.
Money management?
Financial.
All right.
Give a financial report of where the company is at a particular place and time.
Okay. Talking about the financial condition of a company at a point in time. Okay. All right.
Presenting of creating the picture of financial picture of establishment of the corporation.
Okay. So accounting deals with painting the financial picture of a particular entity. That is true. This with money management as well. Okay. We can say that. All right. That's good. So here is what I encourage you to do. Since you are here for 4 years to study accounting, I strongly encourage you to go back to any book and actually take a look at a definition of accounting, right? Different textbooks define it differently. Since you're an accounting major, you should be able to effectively articulate what you are studying in the university. Does that make sense?
Yes.
So that being said, let us just go ahead and quickly go through the accounting definition in our in the principles of accounting that we use, the principles of accounting textbook that we use. That textbook defines accounting as an information system. Accounting was defined as an information system that measures business activities, processes the data, and communicates information to interested parties or decision makers. Okay, that is one of several definitions of accounting. This pretty much captured the essence of it. So let's take a couple of minutes and talk a little bit more about this by zeroing in on some of the key words. Here we say that an accounting is an information system. What is a system? What comes to mind when we talk about a system?
Setup.
Setup? What do you mean?
A structure.
A structure, okay. A particular way of doing something, right?
A series of principles and algorithms that create a process.
Okay, very good. That could be called that could be considered as a system also. Another definition of a system is combination of different pieces or components put together that make a meaningful whole. An example would be your automobile. Your automobile consists of what? Different parts, right? You put all those parts together, it makes a meaningful whole. And the purpose of your automobile is to take you what? From point A to point B. That is the purpose of your automobile. So here we are looking at this system from that standpoint. So the question is, what are the pieces here that we are going to put together that will make a meaningful whole when we talk about accounting system? Think about your accounting department. So if you go to the accounting department of a particular company, what would you see in that accounting department? Everything that you see in that accounting department are the pieces or the components of that system. So what would you see? Number one?
Accounts
Accounts
payable.
receivable.
Accounts
No, you don't see accounts receivable, accounts payable, no.
payable. Computers.
Computers, you are going to see computers. What else?
People.
Calculators.
You are going to see people. What do they call those people?
Employees.
Accountants, employees, accountants, okay. What else?
Auditor.
What else?
Calculators, add machine.
Calculators, adding machine. What else?
Files.
File cabinets, okay. What else? Somebody has to sit down.
Chairs, furniture. I said that.
Furniture, okay. Desk, chair,
Files.
file cabinets, accounting records, the journal, the ledger. Nowadays, most of them are in the computer, right? Software, all right. You can see software, hardware. We talk about computer printers, right? A scanning machine, all right. So on and so forth, right? All those pieces are put together for what purpose? So that we can do what? Measure the business activities, measure different business transactions that the company engage in. That system will also help us what? Process the data or the underlying data. Are you with me?
Yeah.
Then the system will also help us what? Communicate
Communicate
the
the
information to different interested parties or different decision makers. Are you with me? Now, look at, here's another key word here. What is that? Information. The information is being provided to different decision makers or interested parties via through what means? This information is this with what?
Paper. Do reports.
Report. What do we call? We have a fancy name for those reports in accounting. What do we call those reports? Financial statements. You know, that is how we communicate. Primarily, a lot of information we communicate, right? So, listen to me. Look at this definition. What is the most important word in this definition?
Information.
Information. Very good. Listen, a lot of people look at accountants as people that crunch numbers, and that is very true. We do crunch numbers all day long, but the most important thing that we do, or the most important service that we provide, is what? We provide what? Information. Listen, every day in the United States or any other part of the world, Wall Street, La Salle in downtown Chicago, people are making decisions literally on billions and billions of dollars every day, and they don't make those decisions in vacuum or haphazardly. They have to have what? Information, and it's account information. So we are in the business of information. So moving along, let's take a look at the accounting. Let's talk about accounting principles and concepts. What are accounting principles and concepts?
The rules or standards that you have to go by.
Okay, very good. Who has to go by those standards?
Accountant.
Very good. So let's zero in on the principles. Okay, now, what is another name for? We say accounting principles. What else do we call them?
Laws, rules.
Yeah, we also call them accounting rules, right? What else do we call it? What else do we call the accounting principles?
Standards.
How about what? GAAP, remember?
Oh, yeah.
We also
General
call it
accounting
GAAP.
practice, right.
Generally accepted
Accounting
accounting principles. What else do we call them? We also call them what? Accounting what?
Standards.
Standards. We also call them accounting standards. What else do we call them? Now we call them accounting standards what? Codification, or just codification. We are going to talk more about that extensively, I believe, in chapter 2 or chapter 1. All right? Now, guess what? These are all used what? Interchangeably. They all mean the same thing. Are you with me?
Yes.
So, what are they? What are accounting standards or accounting principles?
Rules.
I know they are rules, but what are they? They are guidelines. They are guidelines that accountants use while performing their work. Are you with me? So those are the guidelines that we have to learn in performing our work. why is it important that we come up with these guidelines or with these rules or with these standards? Why is it important?
So that everybody's not doing their own thing.
So that everybody's not doing their own thing, so that the outcome of what we do is the same, right?
Everybody can you can understand mine and I can understand yours.
Exactly. So if you hire an accountant from Chicago State University or a university from New York, South Dakota, it doesn't matter. We all learn what? The same accounting rules. So we are going to apply the rules the same way. The end result or the information that we provide to users is the information is the same. Same thing as, for example, if you're in the city of Chicago and you hire an electrical contractor to do some electrical work for you, right? The electrical contractor has to follow what? The electrical code of the city of Chicago, right?
Right.
So it doesn't matter which electrician that you hire, all of them are very familiar with the city of Chicago electrical code. They follow the code, they get the job done, the inspector comes, the inspector is going to inspect the work based on what? The code of the city, and they say, yeah, it passed. So same thing here. So accountants follow these guidelines during the course of doing their work. We are going to talk more about this. Then the concepts are just the assumptions that we use as a basis for formulating the accounting standards. Moving along, let's take a look at the accounting equation. What is accounting equation? Assets equals to liabilities, then what else? Plus stockholders' equity. Very good, very good. Now, what is the importance of the accounting equation?
What is the important answer?
Yeah, what is the importance of accounting equation? Why is it important?
It has
to
to
us.
balance.
It has to balance, that is true.
What is the importance of the equation?
That is true.
Say the question one more time.
Why is it so important?
The accounting equation?
Uh-huh.
Oh, because that's the standard.
No, it's not a standard.
Well, everybody.
It gives the information.
Yeah,
right?
the information, yeah, very good. This with the information, right? You know, the information are communicated via what? Financial statements, right? And the main financial statements are what? Balance sheet,
Balance sheet,
Cash flow.
cash flow statements, and
income statements, statement of cash flows. Now, is it the end?
No.
Yes and no. This is as far as it goes. However, the stockholders' equity has additional components. We have revenues, expenses, what else? Dividend, so on and so forth. All these are all what? Children of what? Stockholders' equity. So that we can actually expand the accounting equation by doing this. Plus revenue minus what?
Expenses.
Expenses and minus what? Dividend. Are you with me? So the accounting equation can be expanded. We are going to talk more about this because the stockholders' equity can be divided into two sections. We have the contributed capital and the retained earnings, okay? So, now, listen to this carefully. It doesn't matter how far you go in studying financial accounting, even if you have 5 PhDs from different schools studying accounting. Everything that you do in financial accounting from A to Z revolves around this, revolves around the elements of accounting equation. So, accounting to us, what would be the equivalent of the accounting equation to medical students? What would be the equivalent?
Hippocratic Oath.
No, everything that we do in accounting revolves around the accounting equation, right? Financial accounting, everything. Now, what would be the equivalent for medical school or medical students?
Human body.
The human body. Because it doesn't matter how long you stay in medical school, everything that you do revolves around what? The human body. You can, after graduation, you can go ahead and do more work in brain for another 7 or 8 years, or eye for another 8 or 9 years. It doesn't matter. Everything is around the human body, right? So I call this our human body because everything is related to accounting.
Body.
Yeah. So now moving along, let's take a look at the double entry accounting. What is double entry accounting?
Whatever you do
That's
on one
whatever
side,
you gotta
gotta
do
to
on
the
right.
other side.
Whatever you do to one side, you have to do it to another side, okay? You don't know? You forgot? Somebody else?
Credit and debit.
Debit and credit? Okay, it's related to that. So we said double entry accounting states that every transaction has to be recorded in at least two accounts. So every transaction impacts at least two accounts of the accounting equation. When we say at least two accounts, what is the implication of that?
So there
They
would be
can
more.
impact more.
In other words, one transaction can impact more than
One.
Two.
One,
two what?
Account.
Counts.
Two accounts. So, quick example. We bought an equipment for $1,000 and paid $800 to pay $200 later. Which accounts are being impacted or affected?
Liabilities,
Liability for how much?
200.
200?
Asset.
Cash?
800.
Uh-huh.
And assets.
An asset. So you have three accounts being impacted, but only what? One transaction. All right. So moving along, let's take a look at debit and credit. What is debit and credit all about?
Plus minus.
Yeah.
Plus minus?
Increase and decrease.
Aha.
Whenever you have a debit somewhere, you must have a.
What are you debiting? What are you crediting? When you say you debit something, what is it that you are debiting? I know, but what is it? You debit a transaction?
A resource. Or,
You debit a resource?
You debit the account.
You debit an account, right?
okay.
You debit an account. So listen to this very carefully. A lot of people, some people actually say that accountants don't do anything but to do a lot of debit and credit, right? That is true, but we do more than that. But the question is, debit and credit is used, and of course, if you read different textbooks or you Google it, they talk about different things about debit and credit. But in a nutshell, listen to this carefully. When we talk about debit and credit in accounting, it is the means of increasing and decreasing various accounts, because a transaction affects what? At least what? Two accounts. When those accounts are affected, they either what? Either go up or
Go
down. So how do you actually make that happen? How do you manifest that? We use what? Debit and credit. Now, when we debit account, does that mean it goes up?
Not necessarily.
It depends on
It
the
depends
It
on.
depends on the account. Very good. So therefore, it is very important that you refresh your memory with debit and credit rules. Now, quickly, I don't have time to go. We don't have time to go through all of the. Just give me one of the rules of debit and credit. What is the debit and credit rules for asset?
Go up.
debit, credit.
When
Right.
asset goes up,
Debit.
we debit the asset account. When an asset decreases, what do we do?
Credit.
Credit.
We credit it. How about liabilities? When liability account goes up,
Credit.
we credit. When liabilities goes down,
We
we
debit.
debit. So the opposite of what?
It's a credit.
Of
I mean assets.
the rules of assets
Assets and liabilities.
and liabilities are
Opposite.
opposite. How about stockholders' equity? It's opposite of what? Assets. However, remember now, stockholders' equity have what? Different children, right? That behave differently.
Yep.
So their debit and credit rules also are different, right? Look at revenues and expenses, debit and credit rules are different, right? So we don't have time to get into all of that. This is just a refresher. So it is important for you to remember the debit and credit rules. Moving along, let's take a look at the basis of accounting. Let's talk about the basis of accounting. What does that mean? The basis of accounting. What does that mean?
Where
Yeah.
was it founded? Where is the foundation?
No. Okay, to help you out, we have two bases of accounting. What are they?
Accrual based on cash.
Very good. We have the accrual basis and we have the cash basis. Now, these are two approaches. Two approaches of doing what? of reporting, of recording and reporting what?
Information, financial information.
Specifically what? Yeah, financial statements.
Cash flow.
Specifically income and expenses. Right. The balance sheet also impacted, but primarily, how do we oh, by the way, we just talked about the word. What is the difference between record versus report or reporting? Recording and reporting, or record and report. What is the difference in accounting?
One is writing, the other one is selling.
This one, recording means you are recording it in what?
Journal.
In the accounting records, in the accounting books, like what?
Journal
Journal,
entries,
ledger. How about reporting?
That's your financial statement.
That is financial statement. That is when you're actually reporting the information. Very good. So, moving along. So, the basis of accounting, we have two types. We have accrued and cash, right? So, how do we record and report income and expenses? We have two different approaches. We either use accrue or cash. Quickly, what is accrue basis of accounting?
When it happens.
Revenues are recorded. Oh, what is another word for record in accounting?
Recognized.
We also use the word recognize, right? Okay, recognize. Okay, so now, accrued basis states that revenue should be recorded or recognized when earned, when you have done the work, not necessarily when you receive cash. So as long as you have done the work, you have not received cash, you still record it as revenue, right? Expenses should be recognized when incurred,
right?
Not necessarily when it is paid.
Right.
But for cash basis, you recognize it
When you get the
and
money,
report it only when you
receive the funds.
receive the money and spend the money. Which of these two approaches is better?
Accrue.
Accrue. Accrue is GAAP, cash is not GAAP. Okay, moving along, let's take a look at the accounting cycle. What is accounting cycle? What is accounting cycle?
The steps you take to get to the financial results.
Very good. Very good. The step-by-step procedure for preparing what? Financial statements. Obviously, we know financial statements are important because that is the end result or the product that, right, that we produce, information that we provide, right? So how do we go about doing that? Of course, we don't prepare financial statements haphazardly. We have to prepare it what? Step by step, right? Very systematically. You cannot do step 5 until you are done with what? Steps 1 through 4. Now, question, how many steps do we have? 8? That is not true. That is not true. How many steps? No, that's not true.
5?
No.
I can just pick a number. 7, 6.
No.
12.
12?
10.
One's optional.
No.
Wait.
11.
No.
13.
It's a tricky question. All of the above is wrong, and all of the above is right in a way, except for those of you that say 1 or 2 steps, you know. Now, here is the trick. If you look at different textbooks, they are going to have different steps. Some textbooks 11, some 9, some 8. Why? Because of how they arrange what you have to do. So, for example, some textbooks will say, number 1, analyze and journalize, right? Some textbooks will split this into 2 instead of 1. Are you with me? And some textbooks will have 1 step with sub-step A, B, C. And some steps will just, are you with me? So at the end of the day, what is the bottom line? It doesn't matter how you arrange the task that needs to be performed. At the end of the day, we are all doing the same thing. So there is just no, you don't see one textbook, you know, they all do it differently. So we know what the accounting cycle is all about. So we go through the steps to prepare the financial statement. Moving along, what is accounting year? I'm sorry, accounting
Year.
period.
Period. The quarters.
What is accounting period? You remember that?
Ain't that the quarters of when the reports are due or something?
It's a
Fiscal year.
period of time covered by the financial statements.
Okay, something like that. Uh-huh.
At the end of the fiscal year?
At the end of the fiscal year? No. Remember we just talked about
12 months.
sort of, not quite.
12 months.
Remember we just talked about accounting cycle? What is the end result when we go through the accounting cycle?
All the 12-month period that they report their financial statements.
Hold on to that thought. When we go through accounting cycle, what is the end result?
Compare
Financial
the
statement. We just talked about it, right? To prepare financial statement, you have to go through step-by-step procedure to prepare the financial statement, right? Now, how frequently do you need those financial statements?
Every year.
No, quarter.
It could be every year,
Every quarter, I believe.
every quarter. If you want to see your financial statements every month, then your accounting period is monthly.
Okay.
That means you have to go through what? The accounting cycle every month. If you say that your accounting period is quarterly, that means you have to go through the accounting cycle how many times a year?
Every 12 times.
Every 3 months,
Every
4
3
times a
months.
year. Are you with me? Semi-annually, how many times?
6.
Semi-annually, how many times?
Two.
Two. How about annually?
One.
Now, it doesn't matter who you are. Every company has to go through their accounting cycle at least once a year. Why?
Every SEC.
Because the person that is bigger than you and your company said, you got to time out and put your house in order so that we know how much check you are going to send to Washington, D.C. or what? Or Washington, D.C. or Springfield. All right? So, at least everybody has to do it once a year. Now, my question to you is, why? What is the importance of going through this headache every month instead of every 6 months?
It'll be more accurate.
More accurate? Not
Less
necessarily.
words.
That's more work. Let me ask you a question.
It depends on how often the decision maker needs the information.
It depends on the frequency that the decision makers need the information. So let me give you an example. Let's assume that you just won the lotto. After the government has taken their cut, they give you a check for $1 million. And you say, well, I still need to finish my education first before I do anything. So your friend in California called you and said, you know what? I have a business deal in California that is so promising and I need $1 million to start it. So your friend was able to convince you, you wire transfer $1 million to him. He's your good friend. You trust him. Now, you said, I need to finish my education. I know some of you are looking at me and said, if I have $1 million, I will be listening to you, right? Let's assume that you are still going to finish your education. So now, your friend is out there, you are here in California, you are here in Chicago. My question to you is, how frequently do you need to know what is going on in California?
Every day,
You
every
see,
few minutes.
Really? Every day. Really? And every day is not realistic because you still have to give your friend a little bit of room to work the business. You can't just be doing a accounting cycle every day.
You got $1 million to buy though,
So your friends still have to work the business. So realistically, monthly is a good time frame, right? So let me give you some numbers though. Maybe this might hit home. So guess what? The first month, he said, bro, you know, what is going on? He said, oh, I can give you a quick income statement. Things are not that bad as I anticipated. So the revenue for 1 month was $2 million. And the expenses was $2.3 million. So what you have? You have what? Net loss of what?
$300 million, $300,000.
300,000 or 0.3 million, right? He said, dude, what is happening? He said, relax. things are going to get better ridiculously in subsequent months. Are you sure? He said, yeah, I'm sure. So the second month, you are anxious. He said, you know, what is happening? And he said, oh, I have financial statement for you. Guess what? The second month, $3 million revenue. The expenses is $3.1 million.
Oh, it's getting better.
Still negative.
So you have,
You lost me $400,000, bro.
So,
last 2 months.
you said, are you kidding me? I thought you said things are going to be better. He said, listen, look at, our income is going up by $1 million.
True.
We are in a position to make some killing in a few months. And guess what? We lost $300,000 in 1 month, but we only lost $100,000 in this month. So be patient with me. I promise you. He said, okay, okay, okay. So the next month, he said, can you email me the financial statement? He emailed them to you. The third month is $3 million and $3.2 million.
Oh.
Give our money back.
Oh.
He said, whoa, wait a second, wait. Don't forget that he didn't invest any money. It's only your $1 million. So how much have you blew now?
$600,000.
Your $600,000 is gone, gone, gone. So then he said, hold on. Things are going to get better. What do you say?
Give my $400,000, man.
Huh?
Give my $400,000.
The rest of your money? 400,000?
Give my
So that you can
400,000.
just be done. What would you say? Give him 1 more month? You would?
No way.
I don't know.
Okay, you want to try 1 more?
It depends on what it is.
Yeah, yeah, you want to try 1 more? Whatever it might be, you want to try 1 more? Yeah, yeah. So here's my point. By the time your friend set up the business, your friend said, dude, what is going to be our accounting period? He said, do semi-annually. Just give me the financial statement every 6 months. At this rate,
Yeah, you be out of your money.
in
better
6
hope
months,
something change.
you see the importance of accounting period?
You're never
People-
fair to this guy every time I've heard this spiel. You know, most businesses are in the negative for their first year.
That is beside the point. I'm talking about your $1 million.
Right.
I'm just saying.
No, I'm talking about your $1 million, and this is a windfall. It is not likely that you are ever going to get this kind of money again in your life. You're talking about, oh, what is, who cares? That is other people's money. I'm talking about my money.
Right.
Listen, after this month, I would have been gone. Okay, moving along. Let's take a look at the
He was getting gone.
accounting year. What is the accounting year? We have 2 types. We have calendar year, we have fiscal year. What is the difference?
Calendar
If your
year
accounting year is consistent with the calendar, that is January 1st to December 31st, right?
Right.
Now, if you have 12 other consecutive months other than the calendar year, that is a fiscal year. For example, from July 1st to what? June of the following year.
Sure, right.
Okay, moving along. As a matter of fact, believe it or not, we are pretty much done with almost. Of course, we talk about the financial statements, right? We did talk about that. That is very important because that is the end result of what we do. We are in the business of what? What kind of business are we in as accountants?
Information
We are in the business of information, even though most of the information is communicated through what? Bunch of what? Numbers. But we are still in the business of information. So, one more thing and we are done. So, let's take a look at accounting cycle.
These gonna be the steps.
Yeah, we are going to quickly go through these steps, but not in details because we did in Principles of Accounting and we are going to also do it extensively in this class. But I'm just trying to cover the whole of Principles of Accounting in less than 50 minutes. So quickly, let's go. What is the first step of the accounting? of the accounting
Analyze
cycle.
and journalize.
Balance sheet.
Analyze and
Okay, somebody said balance sheet. If this company has been in existence, the first step will be to start with the beginning balance. And the beginning balance will be the balance sheet, right? Items, right? Because the income statement, revenue expenses, you would have what? Close those ones out. Are you with me? Let's assume that this is a brand new company without any balances from the previous accounting period, all right? So, quickly,
Income statement.
no, what would be the first step?
Analyze the
Analyze.
transactions.
Analyze transactions. What does that mean?
Figure out what accounts they affected,
Very good.
in debits and credits.
Very good. All right. You have to think it through. This transaction impact which account? Which account goes up, down, so on and so forth. So you are analyzing it, right? So very good. Number 2. What is the next step?
Journalize.
Very good. Journalize the transactions. What does that mean when we say journalize? What does that mean?
You
In
write
a-
down the transaction, put it in a general.
Put it in the ledger.
No, please don't say that. You have been doing very well.
Well, you don't.
I'm talking about the journal, you are talking about the ledger. Please don't go there. Just hold on a minute. You have been doing very well. Don't mess
So
it
you
up.
talking about like T accounts?
No, I'm not there yet. Please.
That's what you like to write them down,
I mean,
basically. Journal entries.
we record them in the journal.
Record them in the journal. Listen to me carefully. An ordinary person will tell you, record the transaction in the journal. Those are 5 words. An accountant will just use 1 word, journalize. So it's an accounting slang, meaning record the transaction where?
In the
In
journal.
the journal. Okay, now the question is, what is a journal or general journal? What is it? Have you guys seen a general journal before? A journal before?
Yeah,
What does it look like?
big spreadsheet.
Big spreadsheet, that is not true. Big account, that is not true.
Like a little notebook.
Hello?
Paper, the line.
When you start your business today, you go downstairs to the bookstore and just buy this book and just label it here, journal. This is your journal. So a journal is a book. It's an accounting book. It could be a loose leaf binder, it could be this big, it could be this little. It's just a book that you use to record your transaction as they occur in chronological, as I call it, journal, right? So just a book. So now, the question is, quickly, here's something that is very important. We need to know the why. If you understand the why of each step, you don't have to memorize them. Are you with me?
Yeah.
So number 1, why did we have to analyze the transaction? She gave us a good very answer. Why? Because we need to know the impact on the
For which accounts.
accounting equation. Which account is being affected, what to debit, what to credit, right? Why did we have to journalize the transaction? That's a common sense.
To keep a
for
record.
future reference.
Keep a record.
So that we don't forget, we can remember everything. So it's just good business sense to record transactions, right? Now, we recorded the transaction. We record the transaction in the journal, right? By the way, why do we call we also call the journal, excuse me, we also call the general journal the first book of original entry. Why do we call it the first book of original entry?
We're gonna put it in the other places.
What is the implication of this? First.
There's gonna be something to follow.
So we have more what?
Books.
Books. Or record, right? So this is a book or accounting book or accounting what?
Right.
Record, okay? So we call it the first book of the first book of original entry because every transaction has to be recorded first of all in the journal before any other type of accounting record. So that's the second step. What's the third step?
Post,
I can hear you.
post,
We post to what? I can hear you.
ledger,
We post to the ledger. Very good. What is a ledger?
The RT T accounts that help us get a balance?
No. Sort of.
It's a book.
A ledger is another accounting book. Or a loose leaf binder. But nowadays, they're all in computer, right? You have to enter. You really don't see them because computer, right? But it's another book. But guess what? If both of them are accounting book, but they are spelled what? Differently. Why? Because they are designed differently because they have different purpose or different function. Very good. Are you with me? Okay, very good. So what do we mean by the word post? Post to the ledger.
You enter
Input,
input. Yeah.
What does that? What do you mean input?
Like make it
like the
official.
data entry.
No,
Make it balance or.
No,
make
you
it
forgot.
increase or-
The accounts.
no. Post. Accountant said post.
Recording as they occur.
No, that is journal.
Oh.
Listen, this is accounting jargon. In English, that means transfer. What are you transferring?
Information.
Transferring transactions from
The journal.
The journal.
the journal to
Ledger.
the ledger. So you are transferring the transaction from one book
To
to another book. Don't forget now, there's a reason for every step, right? The question is, why are you doing that? You already recorded all the transactions in one book. You're also transferring them or posting them to another book. Why?
Because the ledger shows you the status of the accounts, like the balances of them.
Very good, very good. So quickly, remember in Principles of Accounting, this is how a journal looks like. We have the date column, description, debit, credit. Remember this? So quickly, 1 cash, 30, common stock, 30. Equipment, supplies, 1, cash, 1. Prepaid, insurance, 12, cash, 12. Are you with me? So we record all these transactions in the journal, then we turn around, we post them or transfer them to what?
They all
T
individual
accounts.
accounts.
To their individual account in the ledger, right? Now, my question to you is why?
To
how-
see
to
different
the balance.
categories, to categorize them.
Okay, all right.
So you can tally up the totals on the accounts, see
So that you can
what
tell
your
it.
positive and negative.
Very good, very good. So look at this. Look at the journal. What happens to cash here? Up or down?
Increase.
Cash went up. What happens to cash here?
Went down.
How about this?
Went down.
Up, down, down. So guess what? This is what? Page 1 of what? Of the journal. Sometimes we can have what? 40, 100, 60 pages, right? So guess what? At the end of the week, these accounts are all going up and down. At the end of the week, you ask yourself, how much cash do we have? What is the accounts payable balance? For you to know that, you have to take a calculator and do this plus, minus, plus, page by page. Very time consuming. So some intelligent people in our profession said, let us create another book, another accounting record that will help us. That's a different story. That will help us to determine the balance of each account. So they came up with another book called what? Ledger. So look at what do we have here? We call it what? T account. Question: what is a T account? Quickly.
It's just a small journal.
No,
Just a quick teaching tool.
no. It's for educational purposes, babe. You need to catch this.
Totals of.
No. Listen, write this down. A T account is a representative of a page in the ledger. A T account represents a page in the ledger. Now, what does that mean? Hello? Remember, this is our ledger, right? Let's assume that we have 1,000 pages here, and this is a bank, and the bank calls this customer's ledger. So page 1 is for me, my checking account, page 2 is for your checking account, page 2 is your checking account. So we have 1,000 customers, right? If I deposit money in my account, they go to my page and record it, right? You have your own page. So guess what? So in the classroom, I can flip pages. Are you with me?
Yeah.
So for educational purpose or for convenience sake, we decided to use T account in the classroom. So a T account is one page in the ledger. Another one is another page. So when you get a job as an accountant, don't go ask people where is the T account, because we don't do T account in real life. It's only for classroom.
Oh.
You didn't know that?
No.
Yeah. We got QuickBooks now.
Yeah, we are this now. Yeah. So, okay, moving along. So, you know what T account is now. So quickly, let's post or transfer. Cash is what? 30. Common stock, 30. Supplies, 1. Cash, 1. Prepaid insurance, 12. Cash, 12. Right?
Yes.
Now, why are we doing that?
To get the
So we know the balance of each
So,
account.
what do we have here? 30. This is what?
13,
And what is the difference?
17.
17. And we have the difference on which side?
The credit debit side.
On the side with the larger figure, right? These ones are easy, right? 12, 30, so on and so forth. Are you with me? Now, so what is the purpose of posting from journal to the ledger again?
To find the balance of each account.
To determine the balance of each account, because the balance of each account is not readily determinable in the journal. So when you are in the accounting department and you are looking for a balance of a particular account, which accounting record should you be looking at?
Ledger.
The ledger. If you are looking for a balance and you ask them for a journal, they are going to look at you strangely, because you don't see the balance of accounts in the journal. Very good. Moving along, what is the next step?
trial balance preparation.
What do? Prepare what?
Trial balance.
Nope.
Unadjusted trial balance.
Unadjusted trial balance. Very good. So, what is a trial balance and why? Quickly. What is a trial balance?
You're looking for errors in a balance of the accounts to see if you transferred everything properly.
I'm not talking about the why, I'm talking about what is it. Listen,
Oh.
a trial balance is simply a list of all the accounts in the ledger with their debit and credit balances. Okay, so we know what the trial balance is. So let's go ahead and take a look at the, I can use this side. Let's do trial balance real quick. So the trial balance will look like this. Debit, credit, account. All right, so what will be the first account?
Cash.
Cash, what is it?
Debit 17.
Debit 17. Help me out.
Supplies.
Supplies.
Supplies is what?
Debit 1.
So on and so forth, right?
Right.
Prepaid, insurance, 12. So at the end of the day, the debit and credit should be in balance, right?
Yes.
So question, what is the purpose of preparing the trial balance again? Let me tell you. Remember when we are posting?
List all the accounts.
No. It's a list of all the accounts. That is what it is. But what is the purpose? Why? You have to understand the why.
Balance.
No. Almost. 80%. There we go. Remember? Look at this. 30. 30. You see how we are posting, right?
Right.
If you have 100 pages with several transactions, you keep on doing this, you can make a mistake during the posting process, right? So for example, 30 debit, instead of 30 credit here, if you made a mistake and put debit here, debit, when you prepare your trial balance, it will not balance. That is an indication that you messed up during what? Posting. Then that will make you to do what? Go back and figure out your mistake. Even though nowadays the computer will not allow you to mess up. The computer will do it for you for the most part, right?
Oh.
So the purpose of the trial balance is what? To check the accuracy of your work during what? Posting. During posting. Okay, so now, if the trial balance is in balance, does that mean everything is fine?
No.
Not necessarily, because the trial balance cannot uncover some mistakes. Look at 30. When you were posting, you said 300. With the trial balance still balance?
Yeah.
Yeah, 30, you said 300, it is still balance, but you are wrong. So there are some mistakes that the trial balance cannot uncover. So moving along, what is the next step?
Adjustment entries.
Journalize adjusting entries. Very good. What are adjusting? What are adjustments?
Making changes to some account.
Making changes, sort of. Who uses the word update? Very good. Adjusting does not mean we are correcting something, because correction means you messed up, right? That's not what we're doing. We are just updating what?
Information.
We are not updating information. What are we updating? We are updating accounts. Every account?
No.
The accounts that need to be what? Updated. Why are we updating those accounts?
Because something happened, you either added or took away from it.
No. What is the implication of not updating?
We got more information.
No. What is the implication of not updating accounts that need to be updated? If you don't update the accounts that need to be updated, the end result of your work is going to be wrong. Quickly. Look, what is this? Prepaid what?
Insurance.
Let's assume that our insurance is $1,000 every month for 1 year, right? So instead of paying every month, in January we just pay $12,000, right? So we said prepaid insurance is what? An asset, right? At the beginning of January, we have $12,000 in assets. At the end of January, do we still have $12,000 in prepaid insurance? No. Why not?
Because we used the
We have
1 month is gone.
you have used up $1,000. So your prepaid insurance at the end of January is what? 11,000. So if you don't make the adjustment, you are going to report this on your balance sheet at the end of January as what? 12,000. That is wrong. Then another thing that you would have done is you would not have recorded insurance expense. So when you produce wrong financial statement, what is the implication of that?
You're a bad accountant.
You are going to be giving wrong information to people to make what? Decisions. And their decisions are going to be what?
Wrong.
Off. And guess what happens to your $65,000 job? See, in accounting, in psychology or philosophy, you can BS your way around. In accounting, not too long, somebody is going to find you out.
Right.
You either know what you are doing or you don't. And if you don't, quickly they find out. All right, so we need to make the adjustment. Now, what will be the adjustment that we are going to make here? Now, at this point in time, it is not your responsibility to determine which accounts need to be adjusted or whatnot. After 3, 4, 5 years at the job, you are going to have that responsibility, right? So I will tell you here. So which account should we adjust here or update? Very good. So look at journalize. See, every transaction has to be recorded first of all in the journal, right? So what is the journal entry? The adjustment. What are we debiting? What are we crediting?
Yeah, credit.
Insurance expense for how much?
1,000.
And we credit what?
Prepaid.
Prepaid insurance for how much?
For 1.
So by so doing, what happens to prepaid insurance account?
It goes down.
Goes
to
down.
11.
Are you with me? After making that adjustment before we prepare the financial statements, then we prepare accurate financial statement. Quickly, what is the next step?
The adjusting trial balance.
Post to the ledger.
Aha. We post. What are we
gotta
posting to the
report
ledger?
Our adjustments.
Very good. Remember, we journalize the adjusting entries. We have to now post them what? To the ledger. After posting, why do we have to post it to the ledger? The same thing. We need to determine the balance now, right? Now, what is the next step? Number 7.
The trial balance.
Do another trial balance.
What do we call that trial balance?
Adjusting.
Adjusted
Very
trial.
good. We prepare adjusted trial balance. Now, why are we preparing another trial balance?
Because we've had some adjustment.
The same reason why we prepared the first trial balance. What was the first reason why we prepared the first trial balance?
List of all the
Check for
accounts on the
errors.
ledger.
To make sure that we did not make a mistake during our posting
Posting,
process. Because look at, we are posting again. So we need to prepare another trial balance. Are you with me? And this trial balance would reflect the adjustment, and then these ones are pretty good to go for the financial statements. Now listen, do you notice the pattern here?
Mhm.
Yeah.
What is the pattern?
Every time that you make the entry to the journal,
Anytime you journalize
you're gonna have to
you
do all
post
the rest of it.
to the ledger, anytime you post to the ledger, what happens?
Trial balance.
You trial balance.
Very good. Look at, so in number form, what do you have here? 2, 3, 4,
Right.
5, 6, 7. You see the pattern?
Right.
Same thing.
That's why some people only have like 4 steps and stuff like that, because they can find a lot of those.
Quickly. Number 8.
Prepare financial statement.
Thank you. Prepare financial statement. Should we consider that as the most important thing
No.
out of all of these? It is not. What else is the most important thing? Is number 8 is not the most important. What are we going?
All the stuff in front of the number 8.
Everything is important, but what is the most important thing here?
8.
Oh, number 8.
Yeah.
Why are we going through all these troubles? You want to provide financial information, right?
True.
Guess what? Which of these is your boss interested in?
Number 8.
He doesn't care. He doesn't know how, and he doesn't care. He just wants you to do it right. And you do number 8. So when you are done with number 8, you can actually relax in the office and put your feet on the desk and grab a cigarette or something to smoke or drink. You know why? Because the urgency to get at the information is now, you are now relaxed, right? You have given the information to whomever, but the process is not done yet though. So what is the next step?
Closing.
Closing?
The closing process.
Journalize closing entries.
Very good. We are going to journalize closing entries. What are we closing?
The
Temporary.
periods that
Temporary accounts, and they are revenues,
Expenses.
expenses, dividend. Okay. Now, so we do closing entries. We journalize closing entries. After journalizing closing entries, what is the next step?
Post.
Very good. What are we posting?
Closing entry.
Post to where? Post to where?
the ledger.
To the ledger. Why are we posting to the ledger? The same thing to get the balances of each account. Which accounts are going to be 0? Which, after posting, which accounts are going to be 0?
Insurance.
Huh? Prepared insurance? No. Prepared insurance and asset. We close out the temporary accounts. The temporary accounts are revenues, expenses. So after closing, all those accounts are going to be 0, right? The accounts that are going to remain that are not closed are what? The
Assets.
permanent accounts, assets, liabilities. How come we don't close them? Because by nature they are permanent, right? Can you imagine owing your friend in 2015, January 2nd, your friend said, "Can I have my money now?" You said, "Oh, this is a new year. I closed out my books. I don't owe you anymore." When you have a liability, you carry it over. Asset, you carry it over. Stock or asset equity, the revenues and expenses, they are temporary. So we post to the ledger. No, where's number 11? Where's number 11?
Closing trial balance.
Post closing trial balance.
We prepare what? Post closing trial balance. Oh, by the way, you need to catch this. Listen to this. You see, what is the English definition of post? Accounting definition of
Transfer.
no. English definition of post is transfer. Accountants, we call it what? Post, right?
Right.
But here is another post here. This post does not mean transfer. This is a different post. This is re-English post. The re-English, what is the meaning of post? After. So this is what? The trial balance that we prepare after closing. Why do we have to prepare another trial balance? The same reason why we have been preparing trial balance, just to make sure that when we are posting to the ledger, we did not mess up. Did you see a pattern here again?
Yeah.
What is the pattern?
9, 10.
Journalized.
9, 10, 11, 2, 3, 4, 5, 6, 7, 9, 10, 11. You see the pattern?
Generalized post trial.
What is the next one? Number 12?
Oh, shoot.
Reversing entries.
Reversing entries. This is what?
Optional.
Optional.
Is that the last one?
What is the next step?
Start all over again.
Right.
You start all over again.
What was the reversing? What?
Reversing entries, that is optional. Now, how many of you think that this is pretty fun? Am I the only one just having a good time?
I like it. I
Everybody.
love
Okay.